what's going to give you a way higher win rate is, let's say that we have a body wick and then we come back to the price return zone. That's when you're going to basically go long and put that stop loss right under that body close. Whenever I take these price return zones, my risk to reward is ending up being 1 to 6, 1 to 7. And if you're a quick scalper, you can take these on lower time frames and catch, 40, 50, 60 pips like really easily with having very little risk. Because as soon as you another thing I'm a fan of is just putting that stop loss to break even. Now, so trade, you're risking what's not even yours. So that's the first kind of price return zone, right? The second kind is where we're moving up per se. Let's say that, price has a huge, big move up, and then you start having a little bit of consolidation, and then we have a huge another move up, right? That's the second type of price return zone where you're going to mark out where that pullback, where that red candle was. If you just see all green, 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 green candles, and then you see a red candle, that's where you're going to mark this out. And then you're going to look to see this area had a super strong pull up. That's where the bid in action, right? We had buyers, 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 sellers, buyers step back in here. We know that this is a huge buying opportunity. Now when price, doesn't matter how long it takes, be patient. I know a lot of you guys want to get in, get out the market. Literally just set a limit a couple pips before, right? And one price comes back into here, more times out or not, yes, there is a chance it's going to disrespect it, but I would say a very high chance of the time price is going to respect it and react off of that price return zone. You're going to be able to at least catch 60 to 80 to 100 pips. Now, when this happens, right, you set your limits. That's exactly what you want to do. Just, again, wait to see if it actually respects it super strong. If it have that wick as soon as its body closed, and you basically just set it. Now, another thing of where to take profits, right? So I want to talk something about engineered liquidity. I'm sure a lot of you guys have an understanding of what liquidity is. Now, this is when it comes to taking my profits, what I do, what I don't do, right? So do you guys all know what liquidity is? Yes or no? If not, I can go over. So let's pretend that price is just consolidating, moving back and forth, right? Like this, it's just moving sideways, right? The liquidity is at the highs, right? Like pretend that there's a ceiling holding up, and then the liquidity is at the lows, and there's basically a floor holding up price. The liquidity lies at the highs, the liquidity lies at the lows, right? In a case where we're, for example, in a downtrend, right? Market's making a lower low, lower high, lower low, lower high, lower low, lower high, right? We have untouched liquidity at the highs, and we're breaking structure. We're breaking structure to the lows. So just like in this example, if we have liquidity both at the highs and we have liquidity at the lows, price comes down here. We just took out that low, blah, blah, blah. So this is where you have that untouched engineered liquidity as markets making that lower low, lower high. Now let's pretend that we have, let's say that this is a 100 pip move towards the downside. Now let's just pretend that this same exact fall, these are both 100 pips. Now this is where you want to be careful, right? Is in this case, this gives me a very easy thing when I'm in a trade. Let's say we approach towards a price return zone, this gives me a case, especially if it leaves like a market structure shift. Now I know that these levels are the levels I'm looking for to take profit and see a break of. It makes my job super easy because if we break above here, okay, now our next level is here to target. That's an area where we could possibly get resistance, That makes your job really easy in terms of where to take profit, right? You're just marking out these levels. Now, in a case like here, if the market just dumps, now let's say that, same thing happens, and this has nothing to do with the PRZ zone. We just get a sudden market structure shift. And if we leave behind an imbalance to tap into, this gives you a very clear target of, okay, we have all this engineered liquidity to go after and attack. Now, let's say that in this example, right, we just fell down super strong, and then we have a market structure shift. The probabilities of this market structure shift meaning anything, it doesn't matter if it leaves a fair value gap or any type of imbalance. The probabilities that market's going to go chase after this is very low. Why? Because on the way down where we were selling, this was a huge imbalance of buyers. This was showing so much stronger sellers, right? Doesn't matter if it's the same exact move in terms of length. Let's say they're both 100 pips. In this case, yes, we fell, but buyers were still getting trapped here, right? they're still getting trapped. It's generating liquidity. It's like liquidity provider. In this case, that's not the case. There's no buyers. There's no stop losses resting here. Take profits resting here. But in this case, there is. So it's a way higher probability that we're going to go after and chase it, right? So even if you get the market structure shift, if there isn't something called engineered liquidity or just like that, the setup is going to be everything I'm making sense, guys.
Yeah, I have a question about the liquidity. Sometimes
Yes.
the liquidity doesn't get swept, and then we see a reversal. And then I'm waiting for the liquidity to get swept, but then the reversal's
Before
already
the
happening.
on
How
gold.
do you,
So I'd say liquidity sweeps. If you want to trade liquidity sweeps, that's Nasdaq's job, right? On gold, like I was saying earlier, the reason I really like gold, you're going to tend to see price return zones, the PRZ, the thing I mentioned earlier, get respected a lot more, opposed to we're going to sweep liquidity, right? On Nasdaq, on the other hand, you'll see those, like let's say you'll see the sweep and then the reversal. Gold, I really truly believe that structure again, and you can just study this by, if you want to go on let's go on the 1 hour time frame and look at all the falls, right? Or look at all the directions, right? So here's another PRZ zone right here, right? I think you guys could all agree that as we were falling, this is a down move, right? So a lot of people are like, okay, there's liquidity resting here. I'm waiting for that sweep. Gold is not going to sweep it. Gold is going to respect the price return zone. Same thing here. We're falling. Gold is not going to sweep it. Gold's going to respect the PRZ zone. Now, on the side of NASDAQ, for example, it's the opposite. Like the market will sweep through these PRZ zones. Now, you could say the same exact thing, like this is a PRZ zone, but you'll see that NASDAQ doesn't respect the same way gold respects it. And that's why I really like gold, because you can take these trades and really look at structure, and it really ends up respecting structure. Same thing of the highs, right? So if you mark out kind of like where the highs are, you'll see that even though when you fall, now I'm a fan of PRZs for buying because gold is a bull market. Um, but yeah, anyways, so I think with gold, there's nothing really considered like a liquidity sweep. Now, on a lower time frame, it can occur, but I think if you guys really truly, now this is everything I'm talking about is really strictly for gold, right? I'm not talking about Nasdaq, I'm not talking about anything. I'm just talking about gold. So I think if you guys really just focus on these price return zones, you'll have a very, very, very good time trading gold. Now, gold moves, like, in my opinion, three ways. It's either going to respect the price return zone, which is what we went over. It's going to move in a trend. Here's a very clear move of a trend. Or it's going to move sideways. It's going to range. It's going to trend. It's going to move sideways. So, so yeah, as we see, we can identify zones anytime gold, and this is for days, right? So let's say from Wednesday 16th to 30th, this is 2 weeks of giving you multiple price return zones to catch these super big moves, right? Again, we fall down where we're up, consolidate where that move was, price comes back here. This is where you're overall going to have a way bigger move. Now, I don't swing the thing. I know a lot of people do swing. When I'm trading gold, I'm looking for 60 to 200 pips. After that, even I would say majority of my trades on gold are anywhere from 60 to 120 pips. After I reach 120 pips, I'm very happy. If you're opening up one lot, to be able to catch that multiple times, that's enough for me. I'm not trying to catch the whole moves on gold. So I mainly trade PRZ zones. You can obviously follow the trend on gold. So that's the price return zones. Does anybody have any kind of questions on price return zones now?
Yeah, bro. Like, how many touches you think it's gonna hold the price for? Because I see like you have a second zone there. It didn't hold the price; it just dropped.
And order flow is everything, everything, everything. So there's a use. Now I also have proper like the bid and ask on my chart, but being able to see who's in control. So once we're approaching these zones, for example, these PRZ zones, especially when we top down to a lower time frame, I'm able to see who's in control, the buyers. So within this 1 minute candle, within this 3 minute candle, we can clearly see that these buyers are super, super in control. Let's say we're coming back down to this PRZ zone and you see a sudden push in sells. That's another thing. Now, when it comes to order flow, I want to do a whole nother routine on that. So there's two types of order flow I use. I use this one indicator, which uses live order flow. You're able to see the live orders within each candle. And another thing, so once you're approaching these zones, to have that available. And then I also use footprint charts. So if no one knows what footprint charts are, I'm going to pull it up right now. So I always have like two monitors, and I'm looking at this too. So a normal candlestick is going to tell you three pieces of information. A normal candlestick is going to tell you the open, the close, and then the high, the low. Now, that's good information, but we should go a lot deeper into that. So what do I mean by that? Let me pull up this real quick. So as I'm watching these candles, these are something called footprint charts. So again, like I mentioned, a normal candlestick is going to tell you three pieces of information: the open, the close, the candle. And this is really a game changer. Now, I wouldn't recommend it if you guys are just starting out trading. I think you should really focus on fundamentals first. Sometimes it lags to get this data. Sometimes it's annoying, but you saw it in the beginning. Now, I'd focus, like, if you have a really good understanding of technicals and stuff like that, now when you start using these bid and asks, it's going to be a lot. Dude, this is really annoying. Sometimes it just like lags on you, bro. There we go. Okay, so within these candles, you're actually able to see what a real imbalance looks like. So this is telling you the amount of lots / contracts that are being opened within each candle. And instead of just knowing the high, the low, the open, the close, you're actually able to see the bigger picture. So once I'm approaching these zones, I have this opened on another monitor, and I'm seeing where the imbalances are happening. So a lot of you guys love to say fair value gap, right? I'm sure you've seen, like, thought to yourself, fair value gaps don't even work, blah, blah, blah. It's true. What a fair value gap, all a fair value gap is an imbalance. That's why I like to say imbalance. I don't like to say the word fair value gap. Now, what's a fair value gap? It's an imbalance within the market. So let's say after the market structure shift, we're trending down, and then you create an imbalance, fair value gap, quote unquote. That's meaning that there's so much more buyers and there's a lack of sellers on the opposite side of a move. What does that mean? So let's go to see an example of where we have, basically, you're just going to look for a bunch of orders on one side and a lack of orders on the other side. That's showing that the market's moving too quickly and prices are most likely going to go there, fill some orders before continuing. Now, three consecutive candles will pop up a lot on the chart. That doesn't mean there's an actual flat imbalance. So taking a real the order flow will literally give you what fair value gaps are actually a fair value gap versus just three consecutive candles. Any other questions, guys? Or did that answer your question, man?
I was gonna ask, like, how do you read those order flows, like, basically?
So it takes a little bit. Number one, you want to look for is the imbalances, like I talked about. So that's basically seeing where there's a lack of orders on one side and a bunch of orders on one side. That's going to see. Another thing is it's basically showing you the bid in action. So you're actually able to see who's in control here. Is it the buyers or is it the sellers? You're also able to see something that's called iceberg orders. So essentially what that is, I don't want to get into too much stuff because I want to, like, keep this class, like, very simple, tailored towards PRZs. But basically an iceberg order, a lot of people have this misconception that big money institutions like banks or whatever, you know, they just unload a bunch of lots and they move the market. So an iceberg order is, let's say there's liquidity providers in the market. So let's say that a big institution like a bank wants to load up 1,000 lots, right? They're not going to just load 1,000 lots. What they do is they will put a bunch of orders like a machine gun. So let's say they'll start off with 20. That's why it's called the iceberg order. It's an order that's way bigger than it actually looks. So they're basically put 20 lots, it gets filled, 20 lots gets filled, 20 lots gets filled, and they just keep reloading. That's why sometimes prices just stuck. So that's the real way how big institutions get their money. And you're able to see this pattern by seeing the same same orders coming in. It's not a coincidence. After it happens 3 or 4 times, and then it starts to happen like 20 or 40 times, this is a really big indication that after this is done, the market's going to actually end up having that break. So again, it's like a machine gun. So basically, this is futures, right? So when you're trading CFDs, guys, you're not trading in the real market, bro. You're borrowing shares from your broker. But if you're trading futures, you're actually trading in the real market. So when those footprint charts that I just showed you is a number of contracts being opened within a specific candle. Now let's say that that you opened up one micro contract. Your order would appear there. I'm gonna give an example of how this looks, right? So I'm gonna try to draw to the best of my ability. So a candlestick, right? We have 2 things. We have the aggressive orders, and aggressive orders are basically when you just open up and hit buy or sell, right? So that means you're gonna get filled. If there's someone to take your order, then it's gonna get filled, and that's the real way the market works, by the way. So that's why when you trade like very like low liquidity things, the spread becomes higher. So with futures, there's essentially no spread. During like New York session, or you're trading during during like a high volatility and you're trading like a big market, there's not gonna be a spread. So let's say that on the left we have the sellers. Let's say that there's 2 here, and then we have 1 here, right? So and then there's just a bunch of orders. So what an iceberg order is 20, and as soon as it's 20, and as soon as there's a seller to take this 20, this disappears, right? This gets filled. Those orders are now in the book. So this will get filled, and this level will reappear. And let's say that they end up loading another 20. Now it's not like there's a whole person taking on another 20. This is where you guys come in. If you're hitting sell, you might not get filled in right where you want to be. You're gonna get filled right here. And as liquidity providers, they have the obligation to get filled first. So maybe that's a bunch of these smaller orders taking on this, gets filled, keeps repeating the process. So with order flow, the big advantage is you're able to see these iceberg orders. So let's say that happens again, and then the person loads up another 20. This isn't a normal like trader. It's not a retail trader. They just were able to do this time and time again. And again, they get pushed up to here. So they open up 20 contracts, aka 20 lots, get pushed up to here, make like $1,000, come back here, do it again, make $1,000, come back here, do it again, do it again. So that's the real way that actual banks. If you guys want to look it up on your own time, I don't want to get too much into it because this doesn't have too much to do with it. Just look up iceberg orders, order flow. Something should pop up on and you're actually real where big institutions like banks or hedge funds. So any other questions, guys?
Sound good, bro.